So welcome to our webinar, Fundamentals of the Strategy-Driven Supply Chain. So the Strategy-Driven Supply Chain is the title of my second book, which will be published in May. So we have foreseen 2 webinars to explain the basics or the fundamentals. And then we hope to do an online book launch with a panel discussion to explain, let us say, some of the more advanced questions when it comes to strategy driven supply chain. But before we get started, I would like to ask a couple of questions to you. And my first question to you is, what is a strategy driven supply chain to you? What does it reflect or trigger on your side, strategy driven supply chain? And so I see elements of cost, cash, value. I see elements of the company strategy, business demand versus cash conservation, and that's trade-offs and balancing, and that has a link to strategy. SCM strategy based on product market combinations. So one of the typical questions is, can we have different strategies for different market combination segments? Is something we will come back to in our second webinar. In line with the company and the customer strategy, yeah, for sure, very important. And the strategy aspect will be more prominent in our second webinar, but I see too many supply chains which are overly designed on cost or minimum inventory, and that is sometimes conflicting with the company strategy or the customer strategy. Okay, so thanks for your input. Let me switch back to my presentation. Want to quickly review with you a concept, a supply chain triangle. It's one of the fundamentals we use in the strategy-driven supply chain. And then I want to ask you, have you used it already, or how would you use it in practice? And I will talk a bit on how we use it in practice, that supply chain concept. But one of the basics of the strategy-driven supply chain is that companies struggle with balancing this triangle of service, cost, and cash. And cost is easy to understand. Cash is working capital. And out of the different components of working capital, inventory is certainly the most difficult one, the most poorly understood. And if you think about service, you need to take a broad perspective of service. So service is much more than the on-time and full delivery performance. It's also about how narrow or broad is the product portfolio, how flexible am I in last-minute changes in orders or in order quantities. And costs can be extended, certainly next session where we talk about strategy. If you want to be an innovation player or a product leader, R&D costs are very important. If you want to develop total solutions, well, the sales costs can become quite important. And if we invest in a company, it's not only in inventory or working capital, it's also in fixed assets, like the property, plant, and equipment. And companies struggle with balancing. So we source in the Far East, that's good for the cost, but the longer lead times are bad for the inventory. We expand the product portfolio to improve the top line, to win market share, that's good. But I risk introducing a long tail of slow-moving products, which is bad for the inventory position. I can try to be more responsive by investing in peak capacity. Well, having excess capacity will increase the responsiveness, but of course I need to invest in extra assets, and also operating in peaks. So chasing instead of leveling is not very cost efficient or effective. And desperate supply chain managers have lowered inventories by lowering the safety stocks. That's good for the inventory, but bad for the service. And if you have service issues, you also get operational firefighting costs. So the idea of the triangle remains that as companies, we struggle with the balance, and a lot of it has to do with functional targets. So in general, marketing and its sales is more focused on the top line and market share. In general, production is more focused on efficiency and safety. In general, or overall, purchasing is more focused on cost, on spend. How can I buy more volume for a lower cost? And finance has its own world and its own objectives. One of the important metrics for them is free cash flow. So the free cash flow is the cash flow which goes to the debt holders, the banks, and the equity holders, so the shareholders. And finance doesn't want to disappoint neither the banks, neither the shareholders. So that's an important metric for them. And if you translate that on the triangle, sales is more pulling the top side, operations is more pulling the cost side. And even after telling this story many times, I still see finance in a lot of companies pushing inventories down to generate free cash flow. And that's one of the important links for them into the triangle. And balancing the triangle is not optional, it's really mandatory. That's also one of the fundamentals of the strategy-driven supply chain. And to understand that, we look at the triangle from an investor's perspective. So we say service is a driver for the top line. If I improve service and I don't have an impact on the top line, then maybe I'm just overdoing it. So service is a driver for the top line, the sales revenue. As an investor, I'm not just concerned about growth, I also want to see a margin. Well, if I combine the top line with the cost, I get to the bottom line. The bottom line, for instance, as measured through the EBIT, earnings before interest and taxes. And I'm not just concerned with margins, because if I do two investments of 100 million, but the EBIT of one company is way higher than that of the other, it's really about what's the EBIT which is generated over the capital employed, which is the financial definition of the return on capital employed, or the bang for the buck. So balancing the triangle equals optimizing value as measured by return on capital employed, or bang for the buck. And that is really one of the fundamentals of that whole strategy-driven thinking. Next session, we will talk about how strategy plays a role. If you want to see the impact of strategy, we look at the impact on the triangle, and we look at the impact on how we drive value or generate value as measured through that ROCE. Second question to you. Let me switch back to the Mentimeter. So if it goes well, how would you practically use the triangle? Have you used it before the triangle? How would you use it? And I ask that question because then in a minute, I just want to share a bit our experiences. To explain interdependencies, it's obvious, but it's apparently not obvious in practice. So it can be used to explain interdependencies. Cross-functional, it drives cross-functional behavior. Using it through SCORE model. How would we link then SCORE to the triangle? Analyzing and optimizing the best ROC, for sure. I believe ROCE can be a good criterion to measure value. I often say, if you look at product portfolios, if I have 10 different product groups, well, what I would like to see is what's the margin we generate for those product groups and what's the inventory invested. So the Roce principle can really be helpful to see what is the good complexity, because some portfolios can be very complex and have a lot of inventory, but if the margins are very high, it's good complexity. And what is bad complexity? Bad complexity is the complexity which is not adding value. Inventory decisions in function of customer satisfaction. Generate buy-in for S&OP. Excellent. That's also what I use it for. Drive the internal strategy of the company. So how would strategic trade-offs have an impact? Agree. Seems to be more coming, but I'll need to switch back to my presentation. How we use it, To create awareness, so I won't go in detail here, but Katrijn will send you our vision paper on the 7-step approach, and I use it a lot to create awareness and to create cross-functional alignment. And this was the pre-corona way. Then we did it with brown papers and post-its. Now we just ask people to write down a triangle and to write down what they see as challenges, to take a picture of it and to send it via WhatsApp. So that's how we do it in Corona times, and how I would still like to do it in post-Corona times. And if you want to do S&OP, I often say, but before you do S&OP, first define the problem. And the triangle for me is a very useful tool to define what the problem is. And if you gather a cross-functional team around the triangle, almost automatically, because sales is looking from the service dimension, operations and purchasing might be looking from the cost dimension, finance has the cash interest. So everybody has some interest in the triangle, and it's like automatically you do get a cross-functional understanding of what are the key challenges, and that's what you need before you can start driving improvements. So that's one of the ways how we use it, and Katrijn will give you that broader picture of our 7-step approach. We also have developed an online survey, and Katrijn will also send you that survey. You just need to rank different statements on how you prioritize volumes over margins over inventories. And if you do a workshop, you can also basically use this type of tool to see how different people position themselves in the triangle. So we will send you the link. It's something that you can try and test for yourself, but this is to get the debate in the company started. We also use it to build business cases. So we look at, okay, how does it improve on the service side? How does it improve on the cost side? How does it improve on the cash side? And in the envision phase, if you want to envision a to be, there will be a certain cost associated. You also want to define the associated benefits. So we use the triangle, and we have developed a business case template. A previous webinar with the colleagues of Arkiva was on how to define the business case, but it's also linked to our triangle. And also, if down the road, if you start designing, if you start implementing, if you start rolling out and improving, we use the triangle to organize metrics and follow up the business case. And so this is an example from a current project where we are really defining KPIs on the service side, on the cost side, on the working capital side, how that breaks down to bottom line targets. We will tie in sustainability targets, and we will have different levels, like really the top executive level, regional level, you could say, and then really go to a local level. So that triangle can also be used to build dashboards. And if you have defined your business case here in the envision phase, it's crucial to, in the design phase, define metrics, define the baseline, define how you will follow up and report whether you really drive the anticipated benefits. Second topic is understanding ROCE and benchmarking. And that's a bit more technical, but again, I will then also explain how we practically use it, and we will try to provide you with some examples. But first, I think going back here to our Mentimeter, question to you: what are your key financial metrics? So before I start digging into understanding ROCE and the different components of ROCE, if you would need to name 1, 2, 3 key financial metrics, what are your key financial metrics? And I am very flattered that ROCE is the first one popping up on the screen here. EBITDA, REBITDA, yeah. ROI, working capital, margins, cash conversion cycle. That's already, let us say, quite advanced. Some of these metrics. Working capital to sales, that's interesting. Do we measure working capital to sales, or do we measure it versus the cost of goods? Free cash flow, yeah. I increasingly discover that free cash flow is a key metric to finance. Okay, let me switch back to my other presentation. Yeah, what are the components of ROCE and how do we use it for benchmarking? Today I will explain one-dimensional benchmarking, but we also do two-dimensional benchmarking. Then we can account for the strategy. Yeah, so these are different margin metrics, and I saw some people measuring EBITDA. Yeah, in general, that is before the depreciation and the amortization. Yeah, if we don't invest, or if we underinvest, yeah, then yeah, let us say we don't visualize the depreciation and the amortization. So I like to have a view on it because it's also important to be able to renew assets. And then on the capital employed side, so different metrics for working capital. Days of inventory on hand, days of sales outstanding, days of payables outstanding, inventory turns. And then next to the, so these are working capital metrics. And then next to the working capital, we also have the fixed assets. And the fixed assets is typically composed of the net property, plant and equipment. That's the physical equipment. And also the goodwill. And the net property, plant and equipment and the goodwill together in a large terms define the fixed asset. So we typically look at net PPE turns and at fixed asset turns. And these are some definitions. So when we publish the recording, when I look at inventories, I look at the cost of goods, not at sales. Some companies would indeed look at what is the inventory in days of sales. These are some of, I would say, the typical financial definitions. And it's just important that you understand what the definition is at the moment that you start comparing metrics. To explain a bit how ROCE works, I will compare two companies. We will look at Henkel, and we will compare it to P&G. And after each slide, I will ask you to vote in which company you want to invest. So after each slide, I won't do a live voting, but I will just ask the question: do you want to invest in Henkel or do you want to invest in P&G? And step by step, we will explore how ROCE is built up. So first, two metrics: gross margin and EBIT. And I hope it's readable through the GoToMeeting. What do we see on the gross margin? Well, I see that Henkel has gradually been playing catch up with P&G when it comes to gross margin. So from around 45%, close to 50% gross margin. And we see a comparable behavior in the EBIT. So it's less spectacular in the sense that where the gross margins are very close, in the EBIT, there is still a gap between Henkel and P&G. P&G has the EBIT of around 18%, and Henkel rather seems to be around 14% EBIT, earnings before interest and taxes. So my question here to you would be, mentally do it: in which company would you invest, Henkel or P&G, when seeing these margin metrics? If this is the only information we have, we say, well, the improvements of Henkel in gross margin have been quite impressive, but from an EBIT perspective, it seems a bit more stable. So most probably, if this is the info you have, you say, well, I will invest in P&G. Let's continue. Inventory turns and days of inventory on hand. What do we see here? If we start with Henkel, it has been going up and down a little bit, but inventory turns are now around 5.5. If we look at P&G, it's also going up and down a bit, but there is a clear trend that the inventory turns are going up, or vice versa. The inventory in days are going down. So we see that P&G has done good improvements. Inventory in days down to probably around 50 days, where Henkel is rather around 70 days. So P&G, the better in inventory performance. In which company would you invest? Most probably we stick to P&G. Better margins, lower inventories. Days of sales outstanding. So this is the money we still need to receive from our customers. P&G, around 20 days. So it seems that customers are paying very fast. I believe that one of the reasons is that P&G gives discounts to their customers. If you pay faster, you get a discount. The days of sales outstanding with Henkel are way larger. It's around 60 days. So in whom would we invest? The working capital position of P&G so far seems significantly better. Lower inventories and lower DSO. Then we come to the DPO. Yeah, that's where it gets a bit different. All of a sudden, we see the days of payables outstanding are way larger at Henkel. So Henkel is around 120 days, whereas P&G is around 80 days. And if I look at the cash conversion cycle, which is basically the days of inventory plus the days of sales minus the DPO, you see that they are quite comparable. So Henkel and P&G from a working capital perspective are quite comparable, and actually both are close to zero. So maybe Henkel has a bit more inventory and Henkel has more days of sales outstanding, but Henkel is compensating for that with longer payment terms towards suppliers. So yeah, in whom do we want to invest? Well, if I look at it from a working capital perspective, there's not a big difference. The margins of P&G are still better, so most probably I still go for P&G. Then we look at the net property, plant and equipment, or the net PPE turns. And there we see the turns of Henkel are significantly higher than the turns of P&G. The turns of P&G are around 4. The turns of Henkel are more than 6. So that's a significant difference. So what we are saying is that Henkel is realizing this result, is realizing this level of EBIT with significantly less physical assets, or Henkel is more sweating the assets compared to P&G. If we extend into fixed asset turns, the difference remains comparable. The turns drop, so I go from turns of around 4, I go to turns of less than 1, it's probably around 0.5, and of turns of around 6, I go here down to turns of 1.5, which means this type of companies is often heavily loaded with goodwill on the balance sheet. That's because of historical acquisitions. These are branders. Branders often grew by doing acquisitions of strong local brands. But in any case, Henkel is much more efficient, both from a physical asset perspective as from a goodwill perspective. And that leads to this type of ROCE result. So we say, because Henkel is spectacularly better in an asset efficiency perspective, Henkel is actually the better from an ROCE perspective already as of 2012. So the EBIT is lower, but because the asset efficiency is so much bigger, we see that from 2012, from a value perspective or ROCE perspective, Henkel is doing a better job. So if I look at it from the value perspective, I would say, well, maybe as of this period, I would prefer Henkel as an investment over P&G as an investment. So that's ROCE thinking. And also when you look at inventories, yeah, we are maybe not best in class in inventory, but okay, is that an issue? As long as I can compensate, for instance, by higher payables outstanding, and if my net working capital position is around 0, yeah, when am I, let's say, satisfied as a CFO? Creating that broader perspective and that broader picture is something to consider when we define targets, for instance, for inventory turns. Let me switch back to Mentimeter. So do you have easy access to financial data? The things I'm showing here, how easy is it for you to pull that off? Do you actively benchmark against key competitors? Yeah. Quite often you get targets for inventory turns, but yeah, how often do you compare yourself against key competitors? And do you believe active benchmarking is relevant? So 3 questions for you. See, the votes are more or less stable. Yeah. It's a bit surprising to me that we say, well, the access is, but it's a broad spectrum. You can see the distribution on it. So there's clearly some people who do have access. I think that's how we need to read it. But there seem to be even more people who are doubting how easy the access is. With the average here being 3, my experience is the easier the access is, the more frequently you will do it, and also the more intelligent the benchmarking will become. So I'm a bit surprised that the access is still relatively good and that we still don't do it that often or actively do it, and that we believe that it is relevant. If you look at the scores here, there seems to be quite a consensus that it does make a lot of sense. I'm sometimes a bit cautious because if I explain it, it seems very technical, and then I say, oh, Bram, you're making things too complicated. But I'm happy to see that many of you do think it is relevant. And switching back to my other presentation, when do we use it? Yeah, for instance, here again in that envision phase, we use it when we build business cases. Like a lot of business cases for S&OP are built on reducing inventory, because there is an impact on inventory. But yeah, how aggressive do you want to be in reducing the inventory? Well, here a benchmark can really help. If you are already quite advanced and quite good in inventory, yeah, then maybe you want to be a bit more cautious. And it could be from this type of benchmarks, also certainly the 2-dimensional benchmarks, that yeah, maybe it's more obvious to yeah, to more look at EBIT improvement, and then more look at cost reductions or better prices through improving service. So the benchmark can really help you to, let's say, define a more solid business case. Yeah? And I will quickly show. So we have a tool. If you reach out to Katrijn, and I think that can be done through the survey, we have a couple of reports which we can share and you can play around with. So this is a simple example for chemical companies. So these are 1-dimensional benchmarks. These are 2-dimensional benchmarks, which I will come back to in our second session. So these are some things we are happy to share with you, yeah, to help you drive that 7-step process based a bit on the concepts of the strategy-driven supply chain and the tools we have developed. And I would also say, once you bring the S&OP process live, benchmarking should not be a one-off exercise. This is yearly data, but you can also load quarterly data. Yeah, maybe you can be very happy that you have grown with 10%, but if all your competitors have grown with 20%, you shouldn't necessarily be that happy. And that type of data is relatively easily available. So also think through on how you can include that in your process going forward. And so what we wanted to show here is two cornerstones, the triangle, and how you can use that triangle to do benchmarking based on ROCE as a concept. Next webinar, we will link it to strategy, and through the series of the 3 webinars, we want to bring some of those concepts of the strategy-driven supply chain to you. Thank you. So welcome, everybody. Good afternoon to the part 2 of the strategy-driven supply chain webinars. So just as a small reminder, we have 3 webinars linked to the new book called the Strategy-Driven Supply Chain. That new book builds on the fundamentals of the first book, Supply Chain Strategy and Financial Metrics. And we had a first webinar in March where we talked about or reintroduced that supply chain triangle and how balancing the triangle is equal to optimizing value in the company, and value measured through the return on capital employed. Return on capital employed being the EBIT generated over the capital employed. We introduced the components of that ROCE. So we talked about the different margin metrics like EBIT. We talked about what are the different components of capital employed. And we also talked about how you can do benchmarking across the different components of the ROCE, or benchmarking across the different corners of the triangle, you could say. And instead of just providing the concepts, I also try to link it to how do we practically use it as a Solventure. And we link that to our 7-step approach, where we say, okay, if you want to drive improvement in supply chain through sales and operations planning, you will need to implement the process and you will need to implement a tool. But there are a couple of steps that go in front of that, and there are also a couple of steps after bringing the tool live. We compiled that into a 7-step approach, and I try to link that triangle and some of the benchmarking to how do we use it, and in which steps of the change process do we use the triangle and the benchmarking. Today we will talk about strategy. So we'll briefly introduce a strategy model of Crawford and Matthews. We'll talk about how strategy impacts the balance in the triangle, or how strategy basically impacts your financial metrics. And I will again try to make references to how we as Solventure practically use it in the projects we do. So April and then end of May, that will most probably more be in a panel type of discussion. We want to take it 1 step further and say, but how do I now really include the strategy into my supply chain design? What is our future vision for S&OP, which is really about fully integrating operational planning, financial planning, and strategic planning. And if we really want to balance the triangle and integrate the different types of planning in the company, we also believe we need to redefine the role of supply chain. You could say those are really the new key insights of the new book, and that's what we will talk about May 27th. So let me ask a question to you. So before I explain what I think strategy is, would be happy to hear your thoughts. So what is strategy to you? That's already a lot, and I would say good insights. Choices, will certainly come back to that. Roadmap, also important, like it's about a long-term future, the strategy, and most probably where you are today is quite different from where you want to be. So there will most probably be a roadmap with milestones, also execution. it's good to make strategic plans, but to be also follow through and follow up and execute upon the strategy. What not to do, yeah, that's I think that's an important pitfall. Roadmap here again, long-term direction. Yeah, strategy is certainly about the long term. Strategy is not about tomorrow. You really need to have a long-term, take a long-term view and a long-term vision of the company. Drivers of actions, yeah, I think that's also good. Creating a reference framework, like strategies should give us something to which we can hold on, like a reference framework to which we can check decisions. Okay, let me continue because I have a lot of material to cover. One of the models I often use in practice is the model of Tracy and Wiersema to explain what strategy is. And Tracy and Wiersema say, but other strategy models say the same. In the end, strategy is about making choices. And the book they published in '95 is called The Discipline of Market Leaders. And they studied what defines market leaders. And a market leader is a company that consistently outperforms its competitors over a longer period of time. And a longer period of time is not 2 to 3 years, it's really like 10 to 15 years. And they came to two conclusions. One, market leaders make a choice. And Tracy and Wiersema proposed three options: operational excellence, product leadership, and customer intimacy. And two, once they have made a choice, they are extremely disciplined and focused in executing that choice. Option number one, operational excellence. Yeah, there the primary goal is to have the lowest cost, to be able to get to the lowest price in the market. Giving examples is dangerous, but I always do it. Yeah, lowest cost, for instance, Ryanair. If this would be a live event, I would ask who has already flown with Ryanair. Yeah, pre-corona, when we were able to fly, a lot of people flew low-cost airlines. Why? Yeah, because of the lowest price. That's the primary proposition. And Ryanair has a big market share, but they didn't start with a big market share. They started with 3 airplanes, and they really got to a big market share by a relentless focus on the lowest cost and creating the lowest price. And they did that by starting to fly on regional airports, so Charleroi instead of Brussels. They have only one type of airplanes, which lowers the total cost of maintenance. They try to minimize the turnaround time on the ground. An airplane only brings in money if it's flying, not when it's on the ground. So they try to really minimize the time on the ground of the airplanes, and that relentless focus on lowering the cost and increasing the efficiency, well, that has brought them to the position where they are. Second option, according to Tracy and Wiersema, product leadership. And product leadership is basically having the best product. Apple, when I started working in '98, Apple was near death, and that's when they brought Steve Jobs back in. And today, Apple is one of the companies with one of the biggest market capitalizations, and it also shows the challenge to a product leader, because a company like Apple has been challenged over the last 5 to 10 years by companies like Samsung. And the key challenge for a product leader is not inventing a new product. The key challenge for a product leader is creating a continuous stream of new products. And these are also the companies that easily get hyped on the stock exchange. If Apple launches a new product called the iWatch, and the iWatch is not immediately a big success, it can easily wipe 10 or 15% of the market capitalization. It's almost like each product you bring to the market could be your last product, because it's a big failure. You can get severely punished. So those are product leaders. And customer intimacy, negatively stated, is I'm not necessarily the cheapest. I'm not necessarily the first one with the product on the market, or I don't necessarily have the best products, But customer intimacy is about creating the best total solution. And an example I often give there is IBM. It's not that IBM hasn't done innovations, but I associate IBM with the trusted advisor of the CIO. Yeah? If I'm a middle to large multinational employing a couple of thousand or a couple of 10,000 or even 100,000 of people, I know that IBM will be able to solve my total IT problem. And that has some implications. One, these companies are typically quite sales heavy, because if I want to deliver a total solution, somebody needs to define and conceive that total solution. So you typically have highly trained technical salespeople in these type of companies. And customer intimacy players also are faced with the question like, okay, what will I be doing myself? What are my core competences? But to create the total solution, what are complementary partners I will use to create that total solution? I might not necessarily try to do everything myself. Some of the offering will be delivered by myself, and some of it will be delivered through partners. And in operational excellence, the dominant force is certainly operations, and it's all about efficiency. In product leaders, it's all about innovation and marketing. And in the case of Apple, you can even discuss what they are best in. Are they best in innovation, or are they best in marketing? But those are the two complementary forces at a product leader. And in customer intimacy, it's certainly sales. It's really a sales-driven culture. And you find those strategies across different sectors. So if you look at airlines, you have low-cost airlines. Product leadership, best product, with typically those Middle East airlines, Etihad, Singapore, Qatar. I've never flown them, but at least they brand themselves as providing premium quality. And what would be the total solution in airlines? I would say it's typically the bigger airlines. If I look at United or Delta, they're not necessarily the cheapest. They don't necessarily have the best service. But if I need to get somewhere in the US, I know that United or Delta will bring me there. You can also apply it to food retail. Hard discounters are operational excellence. Product leadership, upscale retail brands. It's a bit less dominant in Europe, but like in the US, you have Whole Foods, Sprouts Farmers Market, Fresh Market. It's like locally grown, anti-allergen. In Belgium, you would have Cru from the Colruyt Group. It's also an upscale retail positioning. Customer intimacy, total solution. The traditional supermarket. You can do all your shopping for the full week with me. I have a combination of A, B, and C brands. So depending on whether you want the mozzarella for a pizza or for a starter, I even have different levels of quality in the portfolio. Fashion retail, Primark, Decathlon, you know it, product leadership. Think about the French and the Italian fashion brands, and then customer intimacy. Again, more bigger traditional retail change, which most probably have clothing for the full family, right? That could be the proposition or the total solution proposition there. And the first question we always get is, do you have experience in our sector? But actually, strategy is much more important than the sector. If you take somebody from Ryanair and you put that person at Etihad, the person will die on the spot. He will say, how can you throw money out of the window like that? Likewise, if you take somebody from Etihad and you put that person at Ryanair, that person also dies on the spot. He will say, how can you be so rude to your customers? So you'd better take somebody from Ryanair and move that person to Aldi, or you'd better take somebody from Etihad and move that person to Harrods. They will feel like a fish in the water. So that's a strategy model, 3C and Wiersema, and it's about, okay, how do we make choices? And just another test through Mentimeter. What type of player are you? And you can plot the dot somewhere in the triangle, because I often see we are a combination of product leadership and customer intimacy. Well, you can put your dot wherever you want. If you think, no, we are clearly operational excellence, you can indeed put it there. So looking forward to see some dots here. A lot of operational excellence and customer intimacy. Nobody really driven by innovation. There's somebody high quality products. Switching back to my presentation, how do we use this? Well, in the previous webinar, I said, when companies want to do S&OP, what I like to do first is a workshop with the management team and start talking about the supply chain triangle. That's what I explained in the first webinar, because the triangle allows to capture the problem. Whether you are physically together or you need to do it online, the first thing we do is clarify the issues. What are the issues we have? Where are we struggling with balancing the triangle? The second thing we want to do is understand the strategy. Yeah. And also there we have tools which can be used in a physical version and which can be used in an online version. And it's an online service. So if I quickly show it, it's a strategy survey. I can now fill it in. I can ask multiple people from the company to fill it in. What do you need to do? You need to select statements. So you need to select 5 statements out of a set of 24 statements. And you need to select statements which best represent the business you are looking at. And if I'm a company which is driven by innovation and high quality unique products, then maybe inspiring products and service will resonate with me. And products that expand current performance boundaries will resonate with me. So what you feel is, depending on the statements you select here, we are able to reveal your strategy. And here you see 2 examples. We can do that in a physical format, then we hand out 24 cards, or we can do that in the online format. And this is the type of results we get. And this is an example of a somewhat conflicting positioning. You see that here on the left. Yes, some people are more towards operational excellence, others are more towards customer intimacy, still others are more oriented towards product leadership. But okay, you can't have 5 strategies in the company. So it's clear that you need to make a choice, and you need to make a choice as a company. You can also not afford that R&D thinks you are product leader, sales thinks you are customer intimacy, and operations thinks we are operational excellence. This is giving conflicting signals within the organization, and it's also giving conflicting signals towards the market. And before we design an S&OP process, we want to understand what is the strategy it needs to support. So in this company, if you want to be a customer intimacy player, you know you will have a broad assortment, you know you will play on service, so you need to develop the right planning processes and tools to support this. If you would be operational excellence, you want to minimize complexity, you want to focus on efficiency. Even the forecasting process might look different. If you are customer driven, you might focus even a lot more on customer integration. If you are operational excellence and you're focused on big volumes, statistical forecasting might play a much bigger role in your forecasting process. So strategy is important. And we typically start with the triangle and the strategy before we dig into next workshops, like, okay, what is the impact on the S&OP process? Or what is the impact on the supply chain design? And this is something we will explain further in the webinar, May 27th, in the meantime. Quick check again with you. Do you believe that you have made clear strategic choices? Wait a second. It's a split distribution, I would say to my statistical students. It seems like some people say no, we have not. It seems like some people say yes, we have. In any case, it's something that you need to clarify. So how strategy impacts the balance in the triangle. I will compare Aldi and Deleuze. Deleuze is a traditional supermarket, Aldi is a hard discounter. Who will have the lowest cost? It's quite simple. Aldi will have the lowest cost. Why? It's their primary focus. It's their primary reason of existence. They want to bring good quality products at a cost or at a price that nobody can beat. Who will have the lowest inventory, Aldi or Deleuze? It's simple. It will again be Aldi. Why? Aldi has a much smaller assortment. Aldi has maybe 1,000 SKUs. Deleuze could have 15,000 in a store. Yeah. So if you have 15,000, you introduce a long tail of more slow-moving products. Yeah. So more slow-moving means the inventory turns will be lower, or the days of inventory will be higher at Deleuze. Yeah. And it's not limited to the inventory investment. Who will have the smallest shop? Again, Aldi will have the smallest shop. Why? If the laser wants to display 15,000 SKUs, they will need to have rack space to display 15,000 SKU or shelf space. And we also know that that long tail will be selling less frequently. So the sales per square meter will be lower at Deleuze. The sales per square meter will be higher at Aldi. It extends into the DC space. Who has the smallest DC? Aldi, because there are less SKUs. If Deleuze wants to have 15,000 SKUs, there will be more picking locations, bigger DCs. And because at Aldi, everything is fast moving, they can even do cross-docking. So they even don't have shelves, let's say, or racks where they need to store the goods. It's really, it's gates coming in and getting out. So the capital employed will be much lower at an operational excellence player like Aldi compared to a more traditional retailer like Deleuze. Of course, the service will also be more basic at the hard discounter. The assortment is more limited, and I may have less choice. How do you measure service? Well, if you want to link it to financial benchmarking, I've noticed that gross margin is a good metric to analyze strategy. Typically, product leaders who have a very differentiating product or a very differentiating brand, they can get to a much higher gross margin. Operational excellence players like Ryanair or like Aldi, they typically work at much lower gross margins. Why? They want to go as low as possible because the lowest price is their primary point of differentiation in the market. And if this is the gross margin, then the cost over here will basically be the SG&A. So it's excluding the cost of goods because the cost of goods is now already in the gross margin. If we link that back to the ROCE principle, return on capital employed, well, the service or the gross margin minus the cost minus the SG&A, that in fact gives the EBIT. And if I look at this figure here as the investor, I say, okay, wait a second. I say to Aldi, dear Aldi, it's okay that your margin is a bit lower. Why? Because typically you can compensate with less capital employed, less inventory. Quite often the working capital is even negative at this type of players, and you are very efficient in the utilization of your assets, the property, plant and equipment, very efficient in the utilization of the distribution centers, shop space, etc. I say to Deleuze, okay, dear Deleuze, you want to have a broader assortment, which is fine. That's a different strategic positioning, customer intimacy, total solution. As soon as you start introducing a broader assortment, it introduces extra complexity. You will need more inventory, and also more investment in DC space, store space, and what have you. So more capital employed. That is fine as long as you can compensate with a higher margin, a higher EBIT. As an investor, I remain concerned with what is the bang for the buck? What is the margin you generate over the capital employed? And what this learns me is different strategies are in fact just different routes to generate the return on capital employed. And I need to ask myself, okay, what is my strategy? Will I follow the Aldi route, which means lower margin but having less complexity and less capital employed? Or will I take the Deleuze route, meaning, okay, I have a somewhat broader assortment, which leads to more inventory and more capital employed, but I'm sure that I can drive a premium for that from the customer, from that broader assortment and the service. So strategy has an impact on our financial metrics. And you can link that back to the benchmarking we introduced. So in the first session, we explored margin metrics. We explored capital employed metrics. We introduced some definitions, and we explored or we compared Henkel to P&G on those different metrics: gross margin, EBIT, inventory turns, days of inventory on hand, to in the end come to an ROCE comparison. What I want to show here is a two-dimensional benchmark. And what is a two-dimensional benchmark? We put a margin metric on the left, and we typically use the EBIT, and you put a capital employed metric on the horizontal axis. So it could be inventory, it could be the cash conversion cycle, which measures the working capital. It could also be the net property, plant and equipment turns, in the net PPE turns, so different metrics over here. And for each year, you plot where you are. So it could be that you say, okay, in year one, my EBIT was 10%. And for instance, my inventory turns were 3. Year number 2, my EBIT was 20% and my inventory turns were 4. And you can track your performance throughout the different years. And where you want to be, looking at inventory turns, is probably over here. This is where we want to be. We want to have a very high margin, very high EBIT, and we want to have very high turns. High turns means low days, so low inventories. Yeah, that's maybe where you want to be, but that's not necessarily where you ever got it. So then we look for, what was your best performance? And your best performance EBIT over inventory could have been over here. And we start plotting what we call best performance lines. And that best performance lines shows all the combinations of EBIT and inventory turns, which lead to the same bang for the buck, the same margin over inventory investment in this specific case. And strategy defines where you are on this curve. Strategy defines that, okay, if I'm a product leader, most probably I will be up left, meaning that a true product leader can drive a significant premium, has a much higher margin, but it's a quite complex product supply chain. So I might need a lot of inventory. Why? If I launch 10 new products, one could be a big success, but I could have 9 failures. That's one of the aspects. If I'm a product leader, I typically have complex products. Complex products means, sometimes niche components from niche suppliers with not a lot of flexibility. So a lot of inventories on raw materials or components, typically also with a relatively high risk. But that's not a problem. Even if I have a lot of inventory, as a product leader, I should be able to compensate with high margins. And at the other end of the spectrum is the operational excellence player. If I go for lowest price, I want to minimize the complexity. I want to minimize the risk. That will basically make me very efficient from an inventory perspective. But at the other hand, I will also have relatively low margins. Why? I don't have a lot of differentiation capabilities, so I won't be able to drive a premium from my customer. And we apply that to real life cases. So that's an example also described in the book, Hershey versus Mondelez. I typically see that companies would say, we are Hershey, our inventory turns are 5.5. Mondelez has turns of 6 to 7. We also want to have turns of 6 to 7. I know, this is not how it works. If you plot the best practice or the best performance curve of Mondelez, you will see this is the best performance of Mondelez. We see that Hershey is actually doing a better job. And okay, if Hershey is really a premium brander, it's perfectly okay that Hershey has a bit more inventory as long as the margins are higher. So where you are really depends on your strategy. And once you understand this, it's perfectly okay to be worst in class in inventory. I could show a benchmark of the toy industry. Lego, the Lego company, is officially worst in class in inventory. They have turns of 1 to 1.5. yeah, which is very bad, you could say, but it's not a problem because they have an EBIT of 30 to 35%, right? So as the inventory is there to support your strategy, yeah, inventory should not be managed in isolation. If we add Hero, yeah, then Hero does have a challenge, right? Because they are lagging behind in inventory turns and in EBIT, yeah. And okay, you can start analyzing what could be a good target for me as Hero. Yeah, how do I step from my performance to the performance of a company like Mondelez? And do I want to connect in the Hershey direction, or do I want to connect in the Mondelez direction? And the direction I want to connect with the curve is again linked to the strategy. If I want to be a premium brander, it's clear that I primarily have a margin problem here. I do not necessarily have an inventory problem. So that's how strategy and financial metrics link to a very tangible supply chain KPI like inventory turns. You can do that for inventory turns. You can also do that for asset utilization, the net property, plant and equipment turns. And you could still do that for other metrics, fixed asset turns, cash conversion cycle. And we have a benchmark tool. I will show it straight away, where you can list different competitors, understand where we are. So we say, okay, as Hero, we are currently at 10% Roce. Trying to step to the 35% of Hershey is maybe a bridge too far, but at least I might try to close the gap with a company like Nestle. Yeah. So how will I get from 10% to 15%? And what is the impact of that step on the different type of metrics I have? And what is the impact of my chosen strategy? So how do we use it practically? Today, I see this type of benchmarking at 2 points in time during the budgeting process. Last week, we had a couple of discussions with the Bose Corporation. They are now in the budgeting for next fiscal year. Supply chain gets some aggressive targets on inventory from finance. They use this type of analysis to say, okay, hey, hold on, right? We are Bose. Yeah, we want to be a product leader. You shouldn't compare us to Chinese outsourced manufacturing companies. Those are operational excellence. We don't want to get the targets of a Chinese outsourced manufacturing company. We want to compare ourselves to other premium brands like maybe Garmin or something like that. So you can use it during the budgeting process, and certainly also when you are building a business case for an S&OP process. Yeah. If you want to invest in new tooling, you want to invest in new capabilities, you need to make a business case. Yeah. If you make a business case, yeah, you, for instance, try to do that on inventory reduction. Yeah, but okay, what is then a realistic inventory target for us? This is certainly also where this type of benchmark tools can be used. Yeah. And let me quickly show the tool we have. So we have a couple of standard industry reports available. So this is an example of a chemical report. So this is the one-dimensional benchmark we discussed last time. Yeah. And you can add companies, yeah, or you can remove companies, which is relevant for your specific situation. And this is an example of a two-dimensional benchmark. Yeah, where I can plot the performance of different companies in 2D, and where I can also plot best practice curves and say, okay, yeah, maybe the performance of Eastman here is a bit too aggressive for me. Maybe I want to get to the level of performance of a BASF. Yeah. What are then the best performance lines of BASF? Where am I today as a company? And how does it help me to come to realistic targets of different elements of the ROCE? During the budgeting process, very relevant. When you're building the business case for S&OP, very relevant. But I would say also try to incorporate this type of information in your exec S&OP process. If you have an exec S&OP meeting and everybody says hooray because we have grown with 15%, but all of your competitors have grown with 30%, then maybe there shouldn't be too much of a hooray. So also thinking through how you can couple some of those outside financials of key competitors into your own exec S&OP process. Yeah, that's also our vision going forward, that we will be able to bring that type of financial information in to that process. If you would still have questions, don't hesitate to reach out to me either on LinkedIn. My email is also in the slides. Most happy to have a short follow-up call with any of you. And of course, we hope to see you all back 27th of May, where we will link some of these concepts, really like, yeah, but how does it now impact the supply chain design, and what is our vision for the future of S&OP? And okay, if we really want to change things and change the way things are being done currently in organizations, how do we also believe, yeah, this will change this changes the role supply chain needs to play in the future. So this will be some of the more next steps and visionary aspects which we hope to share with you May 27th, and hope this was helpful for you. Thank you all for attending, and don't hesitate to reach out to us on any of these aspects, and we hope to see you back at May 27th.